Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that could be a bit confusing, misleading, and take you off course out to make it actionable, understandable, and clear. What a week. What a show. Bobby Hunt, what would you add?
Keep your costs low, keep your investing simple, keep your time horizon long.
Bob, is there any scenario where you would violate those rules you just gave me?
No.
That's exactly right, because in this episode, we're going to talk about an article where someone says to keep your time horizon short. Can you believe you keep your time horizon short, Bob?
No.
Well, they suggest that we do just that. We're going to look at 3 items today. The first one, headline, "The days of set it and forget it investing just ended for many Americans." Do you know what set it and forget it investing is, Bob?
You forget about your money?
Correct. And it also means set it and forget it means you set it up and you forget about it. Does that make sense?
No.
Okay, so it's kind of like when you plant an oak tree in North Texas with an acorn. You ever done that in nature studies?
No.
Okay. So what you do is you plant the acorn and then you don't have to do anything else. You just plant it and walk away.
That didn't work. You gotta give it water too.
Maybe in the early days, every analogy has its weaknesses. But I'll say this, Bob. Once it gets past, I'll say, kind of that sapling stage, you don't have, do we water the oak tree you're looking at right now, Bob, out front? Sometimes. Not intentionally.
Yeah, we don't intentionally.
It rains on itself. So the point with set it and forget it investing is once you set up your investments, you need to treat it like an oak tree, not a rose bush.
Okay.
Because you know how a rose bush works?
Yes.
You're always pruning, always paring, always trying to get it just so, putting those little optimizer rose food packets in there. Forgive me for the arborist listening. I think that's the best I can do. But set it, and we're going to talk about set it and forget investing, why it's ended for many Americans. And also, stocks, are they a sure thing over the long term? This article is saying not necessarily. Keeping your time horizon short. How could they say such a thing, Bob?
I don't know. They said that.
I'll say that. It's probably trying to sell papers. Sell papes. What does that remind you of?
Newsies.
Newsies. So guess what? What did the Newsies say? Always sold papes. What do they want?
Newsies sell papers, not headlines.
Well said. Well said. Newsies do sell papes, and that was one of the big lines. But remember, they say they want like a war or an assassination or something dramatic because it sells newspapers. Same thing with financial advice. What sells the papes, although Newsies sell papes, you're right. I stand corrected. But what sells the papes are these headlines. So, and then in closing, Bob, we're going to start a new segment called Deal of the Week, where we're going to look at value. So with a lot of clients I work for, Bob, we're not just focused on portfolio construction. We're also looking at what's your cell phone service? How do you buy a car? What's your cable service? What are MVNOs, those mobile virtual network operators for cell phones, where you can pay a third of the price? So at the end of this segment, we're going to bring back, I keep getting all this fan mail from you guys. Talk about the Malibu more. Talk about the Malibu more. Just piles and piles of mail. Is that true, Bob?
Kind of.
Probably not. Probably not.
I don't really. Sometimes don't really listen to your meetings. Sometimes when I'm doing heavy and I stick my head down and I hear what you're talking about.
Okay, that I guess so. But what happens, Bud, is it's something we get into is what is the best deal for the client. So it gets into all the particulars of your budget. Yes, you need a budget. So at the top, the days of set it and forget it investing just ended for many Americans. A friend of the show sent this article to me. You know who you are. President Trump's economic policies are sending investors out of U.S. stocks and into cash, bonds, gold, and European defense stocks. Now, Bob, do you know what a European defense stock is?
No clue what it is.
But you've watched World War II documentaries with me?
Yes.
Okay. Here's how it works. A defense stock is someone that builds tanks, armaments, missiles, any type of, that's why they say the word defense, a way of militarily defending your country. So European defense stocks are companies that do just that. They build military equipment. And why do you think continental Europe would need a lot of military equipment?
We're powerful than them, I guess.
Well, we are, and we may not always lend the aid we have historically, but you remember the World War II documentaries?
Yes.
Remember Operation Barbarossa?
Yes.
What happened in Operation Barbarossa?
Oh, I forgot.
Who invaded who?
Germany invaded Russia.
Okay, so this is not Germany and Russia, this is Ukraine and Russia, but the European continent, Bob, has a lot of war. So people are thinking, oh, great, I'll just move my money and invest in military contractor companies and they'll do better. So they give a story of an 82-year-old man that sold half his stock investments. This is Yoram Yarili. He hadn't touched most of his investments through most of his life. This past Tuesday, he said he'd had enough. This 82-year-old unloaded half his investments. He said the decisions are changing daily. And the article explains that the Trump administration's chaotic mix of tariffs, government budget cuts, and it's jolted legions of investors, legions of them, Bob. In the first half of March, individual investors have been trading in their 401ks at more than 4 times normal level, according to Elite Solutions. So the past month has had the most trading in almost 5 years. So, Bob, this is a scenario where people are not keeping their time horizon long because they're fearful. Do you think that's a good reason?
No.
What do you think you should do when you're fearful of what's going on when you're investing?
You should just keep your costs low, keep your investing simple, keep your time horizon long.
Yeah, kind of say that back to yourself, kind of remind yourself of the truth, and it'll help calm you down. In this scenario, I think it's possible this retired business owner, they call him, this older gentleman, he had been watching the news a lot. Oftentimes, perhaps he had more time on his hands because he wasn't operating his business, or he was just more worried. And so he is making some decisions that we would not recommend. And the article continues that based on people's political affiliations, they're more or less likely to keep their time horizon long. So people that like the current Republican administration, they're actually more likely to hold on stocks, whereas people that voted Democrat are more likely to sell because they perceive that politics is a good way of predicting how the markets will do. Now, do you think politics are a good way of predicting markets?
No.
Attaboy. In fact, we've got data on this that under Republican and Democratic administrations, there is not data that shows that either is predictive of a better stock market, and both parties typically take the mantle that they are great for markets. The data shows that it's a great deal more complicated than that. They're also showing that gold, Bob, physical gold, is having a big renaissance. People are scared of stocks. They're just buying gold and gold coins. People are buying European stocks. They're basically they're not keeping their investing simple. They're keeping it complicated. And do you think keeping your investing complicated is bad?
Yes.
What do you think can happen when you make your investing complicated?
You could run out of money because you're doing it the hard way.
Amen. You're doing it the hard way. You're trying to predict which decade gold will do well, which decade European stocks will do well. Gold, by the way, $1 invested in 1800, it ends up being not a lot. It's like $4. Over the long haul, gold doesn't do that great. And we've talked about this a lot, Bob. Jumping in and out of continents and countries for stocks is not wise. This year, I've mentioned this, the European index is up 7.7%. The German index is up 15%, whereas we have a 4% drop in the S&P 500. So if you look at that and you feel, oh dear, I wasn't in adequate international stocks, I think you just need to keep it simple. Like Bob said, either have the allocation or don't, but don't jump back and forth. So wouldn't you know it, they say the days of set it and forget it investing just in it for many Americans. We are going to keep our time horizon
long
over here, irrespective of the news cycle. And then I thought this article was helpful for both myself and our listeners. We can be so excited about stocks. Jeremy Siegel, the professor at Wharton, wrote a book, Stocks for the Long Run, that probably has had it has had a profound effect on the way I think about equities and equity returns. If you ever feel yourself doubting the idea that you should put a lot of money in stocks, read that book. It'll make you very bullish. He's a big bull on stocks. But this article by Mir Statman in the Wall Street Journal, I think it's helpful for us to at least pare our ambitions back and think with clear-headedness. Bob, how old are you?
7.
Did you turn 7 recently?
Yes.
Whoa! Did you know that there are 10 and 20-year periods where stock markets have had a loss? I'll tell you what's wide, Bob. That means someone for your entire lifetime would have experienced losses in the stock market. So when we say keep our time horizon long, did you know that doesn't mean just a decade or two? That actually means close to 50 years plus.
No.
Do you think 50 years is a long time?
Yes.
Yes, it is. I agree. So that's it's a good qualifier for the moniker we give at the outro and intro. We got to keep that, really the outro. We got to keep that time horizon long. What does long mean? Well, let's look at this Mir Statman article. It starts this way. There's a common belief that while U.S. stocks can inflict painful losses in the short term, they are sure to deliver gains if you hold them for 10 years. And if not in 10 years, definitely 20 years. Unfortunately, this perception is a misperception. Yes. So this is true. This is important to talk about. Now, the data here, we got to be careful. But Eben McQuarrie, a Santa Clara University professor, the article says, recently extended the data on U.S. stocks all the way back to 1792. Big asterisk by the RHF market update. I'm always a little suspicious on the quality of the data and how analogous it is and how much we can pull that data forward to today, but I'm glad they did the research. This gentleman used prices and dividends found in newly digitized newspapers to compute the returns. McQuarrie found that while 10-year losses in U.S. stocks occur infrequently, they do occur. And this is one you'll all remember. In the 120 months ended, okay, that's a decade, in February 2009, they lost a total of 37.4%. So Bob, that 10-year period, 99 to 09, you were down 37.4%. That's a 10-year period where you're down 37%. How do you think you'd be feeling at that?
I do not know what that means, but I think sad.
I think sad too. So your account, let's say your account said $100. Maybe it'll say like $70. How do you feel about that?
Sad.
Yeah. That's true of a lot of people. They felt kind of sad. They thought, oh dear, what am I doing? There are other 10-year periods, and you're only 7 years old. There are other 10-year periods where the stock losses have occurred. And check this out. There's 10-year periods. September 1974, August 1939, June 1921, October 1857. We can all remember October 1857. What was going on then?
I wasn't alive then.
I don't know either, Bob. I think there was a banking crisis. That's my guess. You guys can Google fact check me. April 1842. The losses in these periods range from 23 to 37%. So what this tells us, Bob, is that, hey, there are these decades where, hey, we have to realize there could be losses, and we're just going to have to realize that there are risks. International stocks, it gets more harrowing. Italian stocks, Bob. Italian stocks. Do you eat any food from Italy?
Yes.
What food?
I eat pizza and pasta. Those are two of my favorite foods.
Did you know this? Where the home of your favorite foods, they lost 78.2% in the market in the 20 years ending 1979. So from let's say you invested in Italy in 1959, you woke up 20 years later, you're down 78%. Japanese stocks lost 64.3% in the 20 years ended 2009. Norwegian stocks lost 74% during the 30 years ended in 1978. I could keep going. This will scare you from stock investing. I think this is an important thing to remember. If you're investing in stocks, you have to look this data in the face and say, yes, I'm willing to take that risk. Otherwise, you need to be a bond investor or you need to have a small allocation of stocks. Small. So this long run, the article explains, losses compound as well. And it talks about the importance of picking the right stocks. Of course, as an index fund investor, we don't have to worry about that. But if you pick the wrong stocks, check this out. Hendrik Bessenbinder, isn't that a great name, Bob, of Arizona State University, he found out that almost 52% of individual U.S. stocks had negative cumulative returns during the periods of their existence in the 1925 to 2023 period. I'll say that again. A little over half of stocks had negative cumulative returns during their existence from 1925 to 2023. The other stocks delivered modest gains, while only a handful delivered spectacular gains. So, Bessenbinder found NVIDIA, no surprise, NVIDIA, the GPU AI chip maker, delivered the greatest gains among all stocks with at least 20 years of returns within the 1925-2023 period, with an annualized 33.38%. So if you put $1,000 in the stock at the beginning of the 20-year period, you'd have $317,000. That's a lot of money. But as an index fund investor, we get to skip that terrible ride of seeking to pick which stock. What we can do is invest in index funds and keep our cost
low.
I'm telling you, Bob, it's not just low, it's super low with index funds. So 0.03%, which doesn't mean a lot to any of us, but if you do the math, you realize it's basically free. Investing, the technology's gotten so good, and Vanguard's gotten so good, and so has everybody else. You're basically investing for free, which is why they're pushing their advice model so hard. They realize the product business is a break-even business. When they sell these index funds, they're not making money. Vanguard, we know, is not making money. They're a mutual fund company. They're essentially a not-for-profit. But even the Fidelities and Schwabs of the world, they're not making money on these products. They are breaking even in the hopes that you will veer off the straight and narrow path and do one of their expensive products or sign up for their advisory services. Or it's a freemium deal. It's the free buffet at the casino, and they hope that you take the free buffet, eat it, and then go play all their games where they make all their money. You ever been to a casino, Bob?
Yes.
Really?
No.
Do you know what a casino is?
No.
Okay. A casino is where people gamble money. It's like cards. They use cards or a roulette wheel or slot machine. You know what a slot machine is?
No.
It's kind of like a video game, but you always lose over the long term. How much fun does that sound?
Not fun at all.
It's not fun at all, but they engineer it to make it fun. So what these casinos do is they give you something free, like a buffet or free alcohol, and then they just want you to play the games because they know you'll lose. And did you know that some of these investing houses do something similar, not as nefarious, but they'll offer these free products, hoping that you buy expensive products. Should you buy the expensive ones?
No.
Attaboy. And speaking of expensive and not, let's talk about cars, because we want to equip you not just with the ability to invest correctly in financial products, but the ability to think rightly about your everyday purchases. One of the blessings of being an hourly financial advisor is we can take the journey anywhere. Anywhere the client wants to go, we go there, so long as they're cool with paying the hourly fee. Well, one of the pain points I've noticed in people's budgets is the cost of cars. In the last, really post-COVID, cars have just become more and more and more and more expensive. Bob, have you noticed cars getting more expensive?
No.
Yeah, because you don't think about buying cars, do you?
No.
What do you think about buying?
Pretty much nothing right now.
It's a good to be 7 in Dallas, Texas in 2025, isn't it, Bob?
Yes.
It's a nice setup here.
Well, I got what I wanted for my birthday, which was an Xbox. So that's nice.
That is nice. Wow. Bob, we might have to do another segment on how to buy the right Xbox, huh?
Mm-hmm.
Because they got deals going, don't they?
Yes.
It's deal city out there on Xbox. But look, back to the car. You can get for $16,495, you can get a 2024 Chevrolet Malibu with 7,500 miles on it right now in the Metroplex. This is a full-size sedan, great reliability, ready to go. It's not brand new, but it's effectively new. And the lesson here is you don't have to play the game. You can play the expensive car game, but reliable transportation is yours to be had with the 2024 Malibu. Bob, can you see the picture of it?
Yes.
How do you think it looks?
Good. It looks like a regular car, though.
And that's what it is. I mean, I'll be honest, Bob. We're always honest, aren't we?
Mm-hmm.
That's a 10 commandment.
Yes.
So it is a regular car. It is a regular car, but sometimes that's all you need. And you know what else you need, Bob? You need to keep your costs
Low.
your investing,
Simple.
and your time horizon,
Long.
because that's what's going to give us the best shot on our investing journey. Until next week.